Welcome to episode 2 of our podcast miniseries, Model Citizens, AI Compliance for Banks and Fintech Lenders, sponsored by our friends at FairPlay. If you're going to talk about lending and compliance in the age of AI, you have to start by talking about credit risk. After all, credit risk evaluation is where analytics and data science first got its start in the financial services industry. Lenders have for decades been applying various forms of statistical analysis, analytics, machine learning, and AI to the question of who should we lend money to? And as you'll hear in this discussion, the application of those techniques and technologies to the credit decisioning process is not always easy or straightforward. There are a lot of important considerations, including and especially the legal and compliance considerations around fair lending. To help us explore those ideas, Kareem and I were thrilled to be joined by Kevin Moss and Andrada Pacheco. Kevin is a longtime fintech friend of mine and the former Chief Risk Officer for Consumer Lending at Wells Fargo, Chief Risk Officer at SoFi, and advisor to many companies and startups in the fintech space. Andrada is the EVP and Chief Data Scientist at VantageScore and has more than 20 years of experience in analytics and risk modeling. Kevin, Andrada, Kareem, and I talk about the evolution of various analytic techniques in lending over the last 3 decades, the processes lenders go through to manage model risk and regulatory compliance, and how generative AI and LLMs are slowly changing everything. I can't wait for you to listen to this episode 2 in our series. So let's go ahead and jump in. Okay, Andrada, Kevin, thank you both so much for joining us.
Thanks for having me.
Thank you. Thank you for inviting me to this discussion.
Oh, of course. Yeah, no, we are absolutely delighted to have you both. When we were thinking about this topic for this episode, which is credit risk analytics in the age of AI, literally the first 2 names that we came up with were the 2 of you. So Kareem and I are delighted to have you join us. Before we get into what I would call the more kind of cutting edge stuff that is sort of occupying people's brains today, I want to give a little context on sort of AI and credit risk evaluation, because obviously the use of the term AI in credit is not new, right? Everyone on this call, I think, very well understands that. We've been talking AI in credit for a very long time. I think what's changed is when we say AI, what do we mean and how are we using it? And so I'd love to start by just getting a little crash course or a little history on when we've used this term AI in the context of helping lenders make credit decisions. How historically have we been using that term? What did it mean? And then how has that evolved over, say, the last, 3-4 decades? Kevin, given your long tenure and many stops along the way leading different credit risk organizations, I'm going to direct this question to you first, but Andrada, I'd love for you to jump in as well.
Sure. Well, when I was thinking about the question, I was thinking about how we used to do things. And, in the 1980s, I went to the American Statistical Association annual meeting in Las Vegas. And I actually sat in on the class. I think it was 2 Stanford professors on CART, classification and regression trees, right? Mm-hmm. And thinking about probably my first exposure or use of AI was really CART and Shade, right? Where we use them for everything from helping with segmentation strategy, like the sort of top part of the tree. They're tree-based algorithms, which, were predecessors to some of the more advanced ones like gradient boosting. And we used to use the top part of the trees, which were the most significant splitters, to help us figure out, when we were building even logistic regression models, how to segment the populations, right? Mm-hmm. They were helpful in decision trees, went around policies, when we had a model, what else could you add on top that added additional predictive value between goods and bads. So card and shade actually, I think I've been using them for over 30 years. And, in fraud, we used them a lot in transaction fraud strategies to in addition to like the Falcon scores and the other transaction fraud scores we have. Then, more recently, I'd say that AI helps in sort of reducing the dimensionality of features, right? Like you can literally have thousands of features. If you're using credit bureau data, you could have a couple of thousand. But then if you're getting into things like cash flow data, you could have literally tens of thousands. And so, you may not even be using the final model as an AI or machine learning model, but AI, some of these techniques can help you shrink, let's say, thousands of features into the few hundred that might be the most predictive, right? And then lastly, like I'd say, I built my first machine learning credit model was probably around 2016, 2017. And we use gradient boosting. And most of the credit models that I see today are using gradient boosting techniques. And, there's some constraints like, not using data that's only, goes up or goes down, you don't get these crazy interactions, monotonic data, sticking to the traditional characteristics. But gradient boosting does a good job with transaction data and with cash flow data. I've worked with Prism as an advisor. I've been using deposit transaction data since the early 2000s. They do a pretty good job. And what I see is, build a traditional logistic model as a benchmark. And then if you can beat that, then you go to higher forms of modeling analytics. And typically what I see is gradient boosting probably beats logistic 15 to 25%. So you can get some real lift and separation, AUC, whatever metrics you want to, divergence, whatever metrics you use to measure separation. Gradient boosting does a pretty good job. And then if you constrain it to be monotonic, you can start to use some of the similar techniques for determining the most significant characteristics and adverse action and things like that. So.
Awesome. So kind of this kind of slow evolution. Andrada, what would you add on top of that from your experience?
From my experience, it seems to me that nowadays, we're talking about much more, black box models. And, that affects what I do because, we really definitely need to have explainability, like really particular explainability, right? We're looking at FCRA compliance and we have to really output to the consumer or to the lender to be used to, facing the consumer adverse action reasons. And that's the challenge where we still kind of, deal with that. We've tried a lot in our space to, create something above logistic regression. And we've been seeing that the benefits, comparing to the cost of explainability, they were not quite, tipping the balance towards using a XGBoost, for example. But we had, we had other ways to include, machine learning techniques, and I can talk about them, in a bit. Just pretty much on the back end of the process of model development, that we would have that, explainability and transparency for the models. But that's been my my experience. Now, on top of everything else, now we have Gen AI, right? We have LLMs and NLPs and whatever you want to call them, transformer type models. And that's another challenge. And, actually, we are challenging ourselves to include that kind of modeling in credit scoring with keeping the explainability, and where is the niche that we can use that type of technology.
And Andrada, just to follow up on that, and Kevin, interested in your views too, just for the audience, like, can you talk a little bit about the difference between some of these newer techniques like large language models, maybe compared to some of the gradient boosted models that we've been using historically in financial services?
Sure. I mean, definitely, to me, the difference is one type of modeling is pretty much looking at learning, right? The AI in a classical way, machine learning approaches, they are actually looking at learning, as the name says itself, right? They're looking at patterns in the data, and they actually can recognize some kind of outcome, right? They're going to recognize a yes or no in my world, default or no default in the next 2 years, right? They're learning, and they are just telling you the outcome. The other large language models now, they actually improve or complement these machine learning models because they're actually able to create new content. To me, I'm thinking about I have a talkative, bright child, right? That is also that is able to, learn from what I'm showing him, and he says, "Oh yeah, I'm looking at pictures and recognizes pattern that a cat has a bigger tail or a smaller tail than a dog, and shorter ears than the dog." And at the end of the day, saying, "Oh yeah, this is a cat, it's not a dog. I recognize that pattern." But for a large language model, it's pretty much telling you, "Oh, why do you think this is a cat?" Right? So it elaborates and kind of talks back to you. It's more like a know-it-all type interaction, and is definitely based on text. At this point in time, we're looking at text, human recognition of text, and trying to tell a story about the outcome.
Yeah. I mean, I wouldn't add a whole lot to what Andrada said, other than saying that, the regulatory comfort generally lags the development or use of more advanced modeling techniques. And so what you'll find is it really depends on the application of these things. So talking about transformer models, I think Stripe came out and talked about the use of them in transaction fraud. And now, generally what I see is some of the leading fintechs, and you have, really, really sharp data science teams, and they want to be using the latest and greatest. But the issue around credit, I think credit modeling has to be held to a higher standard. The worst that happens in a transaction fraud thing is a transaction gets falsely declined, which is a little bit of an embarrassment, but it's not nearly as bad as declining someone for credit. Okay. And so I'm a little bit skeptical. LLMs are basically black boxes,
Correct.
right? They're very complex. They're deep, neural networks, deep learning tools, and sort of unsupervised in a sense. And so I think the likelihood of bias and regulatory challenge is much higher, at least in a gradient boosting model. I know what the features are. I know how they're interacting, and I can test it more easily, I think, than I can an LLM model. So I think LLMs make great sense for things like when we talk about default risk, like bond default risk or commercial defaults. But I think consumer credit scoring has to be held to a higher standard. And I'm not saying that, things like Shapley and Lime and some of the techniques that are out there to help explainability can't be used here. But I think it's going to take some time for the comfort level around regulators and compliance people and all that to catch up with what the coolest new techniques are in town, So.
Yeah, I mean, you're touching on an area that I want to get into a little later, which is just this tension that exists between the predictive power of models and the explainability of models, right? And like those two things are, I think, always in tension with each other. Obviously, based on the larger theme of this series, we've been talking a lot, Kareem and I, about fair lending and just these other expectations that we layer on top of models, because it's not just about their predictive power. Before we get there, though, a question I do want to ask, and Kevin, you sort of hinted at it when you talked about Stripe and what they're doing in the transaction fraud space, is we are seeing LLMs infiltrate different parts of financial services. And, even in consumer financial services, I would agree with you. I don't really see any in production examples of LLMs making credit decisions, but we do see them in fraud. And I think even in a credit risk or credit decisioning context, there are other places, maybe more focused on like operational efficiency, where LLMs can be applied.
Text data, where there's textual data, it could be chatbots, it could be collections calls. Not that there isn't some of the same risks, but I think that where you're consuming text, LLMs are really good at understanding the interaction and creating, value out of that. So, but, like I said, I've always operated under the point of view that credit scoring is held to a higher standard. And whether disparate treatment is recognized or not by the regulators, going forward, you got to do all the same things to find overt discrimination, the same way you do with disparate treatment. So you just have to dig deeper into like lenders and operating centers and underwriting centers and sales forces and redlining. Like you're looking for more causality in overt discrimination, whereas in a disparate treatment assessment, there may not be any causality other than just the nature of the model or the characteristics that you're using. Okay. So the bottom line is, like, I think LLMs are exciting, but I think, at least for my clients and in the places I interact with, I would caution them to be very careful with LLMs for consumer credit decisioning right now.
Yeah, no, I think that's fair. Yeah, Andrada, I was going to ask, please layer on your take, because I think I'm curious both for what you would add to Kevin's point on caution around this, but also any areas outside of core credit decisioning where you've seen LLMs get applied.
Totally agree with Kevin's take. Seems to be that there's a lot of caution around integrating large language models in any credit risk evaluation. If anything, to your point earlier, the use cases are around efficiency, productivity, wherever you have really low risk of violating explainability and fairness standards, right? Definitely, I could see areas where it could be useful in consumer education, right? If we can find a way to, kind of gather all this text about, credit scoring, like what credit score, benefits are, or how you can improve your credit score. And there's a lot of text around it. That may be an area that we could, kind of dig into. But definitely looking at pretty much communication, anything that is related to just text processing. And we're looking for ways to include in a credit scoring model, but I don't think we're there yet. If anything, again, going to the back end and try to create attributes or variables or features, whatever they call them these days. I learned it in school as variables.
I learned it as attributes way back in the day, and that's a bad word now. You don't use that one anymore.
When I got to VantageScore, they called them attributes, and then now everybody's calling them feature because they're data science is not statistics. So, anyways, that's the accolade. But you could do something there to kind of almost mine into the data, text data, to create variables to input in the model.
Create structured data out of unstructured data, basically.
Exactly.
Right? Like I think collector notes is a great example, right? Like
Exactly. It's almost like narrative codes that they have in the credit file. That's the only text I have on the credit file to work with.
Right.
Exactly.
And we already include that in other variables in the model, because you're going to see foreclosure on the narrative code. Of course, is going to be reflected in the payment pattern, so it's already taken care of in the model. But we're stay tuned. We're looking at methods to kind of dig into this opportunity as well.
One of the great benefits of AI, of course, is its ability to consume much more data than traditional modeling methods. And I wonder if you could both speak to, and maybe Kevin, I'll go to you first, speak to some of the new and non-traditional forms of data that are being increasingly used by credit modelers in the underwriting process.
Yeah. Well, I mean, most, I would say, banks are still mostly sticking to FCRA compliant data. So yeah, you have the traditional 3 or 4 credit bureaus. You have some stuff that's out there in telecom and utilities, but personally, I think the most exciting new data source, and it's been around. I mean, I've used on-us deposit data, transaction data since the early 2000s. But I think the Plaids and Finicities, the Financial Data Exchange, has made off us or other people's transaction data from their deposit account that available. Now, the thing that most people, we talk about AI, but I want to talk about the interim step, which is where the real IP is in taking raw transaction data, is creating the attributes or features, depending on what you want to call them, that summarizes the information value in that transaction data. Now, categorization is not 100%, right? So it takes years of learning to get categorization right. And there are a handful of companies out there that have done this for a while. But once you get to that level, then AI or even logistic, can actually add real value. Like my first model that I ever built, which was on us data, I got a 10 to 15% lift from just incorporating about 100 deposit transaction attributes, like how long the deposit account was open, the overdraft and return item history, like some pretty basic stuff. And so, but when you really double click down on that, where does it help the most? It's not going to help me. I have a long credit file, but for someone who's relatively young or new to credit, or the unbanked side, like normally, depending on what you believe, something like 80 to 85% of people have a usable credit file, but 96% of the people in the US have a deposit account. So I feel that because of that, that creates the opportunity for people who are either in the subprime credit files, which are separate. Alex and I wrote about this 3 years ago, that there's, subprime credit people, because of the way credit data is stored, don't get mainstreamed, even if they're paying their payday loans and buy here, pay here loans, successfully. They're not getting the benefit in the main credit file. So deposit transaction data, because everybody virtually needs a deposit account, I think offers the greatest opportunity to mainstream people who are unbanked or underbanked. And I think we're starting to see that. And now the work that the Prism Datas and the Novas and the those kind of companies are doing, I think is creating the opportunity. And Vantage as well.
Yes.
Thank you. I got to make sure I give Andrada credit here too. Vantage also has a version as well. And I think this is great because at the end of the day, it's about creating opportunity for more people to help their financial status and inclusion by taking advantage of reasonably priced loans.
Yeah, so just to add to that, we've developed VantageScore 4 Plus, was launched last year with lots of pilots underway. And it's actually a real-time adjustment of VantageScore 4, one of the most used credit scoring models out there in the market, that actually uses cash flow data over and above the credit data. So that's what's different about VantageScore 4 Plus. It's not only a cash flow score, but a credit and cash flow or bank data. And the benefits are, as you said, Kevin, they are definitely, providing a second look at consumers' risk assessment, showing the entire picture of their financial health, and really helping lenders actually to increase their lending opportunities without increasing, the risk on their balance sheets. And we see the most lifts in the, thin file population, limited credit files, young to credit, inactive even. So there's a lot of benefit there.
Yeah. And I was just going to say, to add to what Andrada said, I really believe that the best credit models will be a combination of the credit bureau data and the deposit transaction data, because there are things that we know in the credit data that we can't impute from the deposit account. And then there are things from the deposit account that we don't know in the credit file. And so a good data scientist is going to basically figure out a way to take the most predictive elements from both. So
both worlds.
Yeah.
Yes.
Yeah, absolutely. I could go down a whole rabbit hole on cash flow data being added to credit data, but I do want to circle back to some of these questions we were raising around the use of both alternative data and AI in the context of explainability and fairness, right? And Kareem, I'm going to sort of pull a left turn here and actually call you off the bench to answer this question. So I'm going to direct this one to you. But I'm wondering, before we start talking about how these different analytic techniques can be applied in a way that is consistent with fair lending expectations, if you can just give us a quick primer on what those fair lending expectations and requirements are in a credit risk context, and just give us the high level, maybe a little song and dance on kind of where we are with disparate impact as well, because I think that's very relevant to what I want to ask Kevin and Andrada about, which is like, how do we then meet those expectations, especially as new analytic techniques come along?
Yeah, well, there have been historically kind of two fairness regimes applicable in consumer credit: disparate treatment and disparate impact. Disparate treatment you can think of as asking the question, are the inputs to my decision fair? Am I making decisions on the basis of legitimate credit factors? Or am I using inputs that might actually be proxies for sensitive attributes that shouldn't be used, like age or gender or race? And so historically, the practice has been to do pretty rigorous analysis on the inputs to understand if those inputs have a legitimate relationship to creditworthiness and aren't actually capturing some of this other protected status information. And then the other fairness regime that's been historically applicable in financial services and in consumer finance is called disparate impact. And that asks the question, are the outcomes of my decisions fair? If there are disparities in my decisions, are they also being driven by legitimate risk factors? So if I'm approving women at lower rates relative to men, is there a legitimate business necessity for that disparity in the approval rates? And if so, could you have been fairer within your risk tolerance? So if you're approving women at a lower rate than men, was there some method that you could have been fairer to women while still meeting your business objectives around accuracy, profitability, and so on and so forth? Now, that second fairness measure, disparate impact, has been in the news quite a bit lately because the new administration at the federal level is declining to supervise and enforce the disparate impact regime. But it's really important to note that even though they are declining to enforce it, Regulation B, which still gave rise to that theory of fairness liability, remains on the books. And so I think all lenders have to ask themselves a question of whether or not they're going to comply with the law, even if there's not a cop on the beat. In addition, many states have disparate impact laws or can bring cases under different disparate impact theories. And we saw just a few weeks ago that Massachusetts levied a $2.5 million fine against a major fintech lender who was using AI and alternative data to make student loans for failure to conduct disparate impact testing. At the same time, that Regulation B, which gives rise to disparate impact as a fairness theory, also provides a private right of action for plaintiffs' attorneys and consumers to sue under that law. So there has been a retreat from federal supervision of disparate impact, and yet what we're seeing is at the state law and at the in the plaintiffs' bar, that theory of liability is still very much alive. I would also add, and this is maybe a little bit of a theoretical point, but I think it might be relevant to folks in our audience, that the line between these two measures of fairness, disparate impact and disparate treatment, is actually incredibly thin. For example, let's say that a lender uses a credit score cut of 650. Well, we know that the distribution of scores for certain groups, like Black and Hispanic consumers, may be lower than for white consumers. And so we know that the use of a 650 score cut may have an adverse effect on those populations. In a case like that, where does disparate treatment end and disparate impact begin? The line is very blurry. So our advice to folks has been to continue with the historic practice of evaluating their fairness, both of their inputs and of the outcomes of their decisions. And by the way, historically, these fairness analyses have been done of the core underwriting decision, the like approve, deny decision. These fairness analyses have been done of maybe pricing decisions and line assignment decisions. But one of the things that we're starting to see as machine learning, AI, and alternative data expand to other parts of the customer journey is that folks are asking, hey, was that marketing decision fair? Was my fraud detection decision fair? How about my identity and income verification decisions? Were those biased? heaven forbid, are my account management, my collections, my claims administration decisions fair? So what we're seeing is not an increase in the kinds of decisions that are being evaluated for fairness and the kinds of players in the financial services ecosystem that have fairness obligations for the first time.
Yeah, and I said it earlier, Alex, but again, Kareem is the expert, but I'm an advisor with FairPlay, and what I've been talking to Patrick about is that, in my view, whether federal regulators enforce this or not, like the same analysis has to be done for overt discrimination. And so, while disparate impact might not be enforced, I think the regulators will probably end up going deeper looking for overt discrimination as a result. And therefore, I would advise lenders to be thinking about evaluating their underwriting centers, evaluating their sales centers. Like if you have these disparities, there has to be nobody can just close their eyes and say, hey, we don't need to know why now. Okay. Actually, right. I think knowing why may be even more important because now there's going to be more drill down, I think, into the overt part of the discrimination process. Okay. So I think it's even more important to have services like FairPlay offers, but I think FairPlay is going to end up digging more into some of these other levels to help clients make sure that they fully understand what the drivers are. So,
yeah, I see Kevin. I see Kareem nodding, so I'm sure that's probably true. I think the other thing I want to dig into, kind of building on that, and Andrada, I'll come to you with this one first, is so there's this idea that we have inputs and we have outputs, right? And you want to rigorously scrutinize both. Everything, Kevin and Kareem, that you shared about sort of the current regulatory environment, we had a much longer discussion about that in episode 1 of this series about just because the federal level is retreating doesn't mean that you're going to want to take your foot off the gas here, really change too much. But the other aspect, which has already come up in our discussion and I want to double click into, is explainability, right? And so can you not only tell us, hey, the inputs into this credit decisioning process are not proxies or closely related to anything that would be fair lending discrimination. The outputs are not having a disparate impact on protected classes, but also the kind of the messy part in the middle is something that we can explain. We understand how it works. There's also an obligation under these same sort of laws coming out of the 1970s to be able to explain to a customer, if you decline them for credit, why you decline them. And obviously, that importance of explainability, relatively straightforward when you have simple scorecards and even logistic regression and decisioning models. It becomes a lot more difficult when you start using more sophisticated machine learning techniques. So, Andrada, maybe you can give us a little bit of an overview on how explainability has been sort of tackled as these AI techniques have continued growing in their sophistication.
Be happy to. I think there are robust ways to actually innovate and actually ensure that credit scoring models are explainable and they're not actually a black box. And an example that I can give is the explainable AI innovation that VantageScore brought to the market, and it was used in the development of VantageScore 4. Now, for context, VantageScore 4 is the fastest growing credit scoring model on the market and is now used by thousands of lenders. And as of last 2 weeks, now is one of only the two credit scores that are accepted by Fannie Mae and Freddie Mac in mortgage. So what we did there in VantageScore 4, we actually leveraged machine learning. Specifically, we leveraged random forest methods. And we did that to extend the scoring to limited or sparse or no-file consumers. Maybe that's common knowledge, maybe it's not, but VantageScore 4 and VantageScore in general does not subscribe to the decades of old minimum credit scoring criteria as our competitor. So that enables us to provide an accurate credit score for consumers that are young to credit, they just started the credit journey, consumers that haven't been active with credit, like my father-in-law. I keep telling him, like, keep using your credit card. If not, you're not going to have a FICO score, but you'll have a VantageScore. And consumers with no trade lines on file. So, we kind of managed to apply different methods to this population. And why we did it is because, yes, in general, you could say that the data is sparse around them, right? You're not having, much history. You're not having much information. But if you go and apply a machine learning technique at a very granular level of the data, just the raw credit file, pretty much, and you let the machine learning model kind of gather the most predictive information, the most predictive elements, and then take them and create an FCRA compliant, transparent, completely interpretable feature or variable, and you put that into a classic logistic regression, then you're going to get explainability right off the bat, but also the prediction and accuracy. So pretty much, as I said before at the beginning of this podcast, is using AI at the back end in the model variables building stage, right? And then introduce them into a completely explainable framework and transparent modeling technique.
Yeah. And I would just add to what Andrada said that which things like monotonicity, like making sure that things go up when they should or they go down when they should, using characteristics that are well understood and their relationship to credit performance. Like most of the things I've seen in my career where people have gotten into trouble with fairness in models is because the underlying characteristics or features that were used shouldn't have been in there in the first place. Like, great example, I've seen a model where, very predictive. People were like, the actual dollar amount that you paid down of your mortgage, right? So think about this for a second. So
yes.
Bigger mortgages are going to have a bigger opportunity to pay down more than smaller mortgages. Now,
Right.
Going back to the earlier discussion, isn't that like an unintended consequence of fairness?
Mm-hmm.
As soon as you said, let's change it to percentage of the mortgage, that predictability went away. But originally, this model never went into production because the people who built it were just blindly using predictive value and not thinking about the implications of what that characteristic really represented. So I think there's a lot of common sense that goes into this too, in addition to all the analytics that FairPlay does. You got to know that the variables, the predictive values that you're using make sense, and that the relationships are something that you can explain to people. Creditworthiness. I think that is definitely a risk in some transaction data where it's not always easily understood. Like, many years ago, I won't say who, but one of the major scoring vendors and a association had a bankruptcy score that was built on transaction data. It was actually quite predictive, but what went down for was some of the features that were in those models were very hard for people to digest and understand when you gave adverse action on them. So Ultimately, I think one of the challenges with transaction data is to make sure that you're using things and creating features that people can understand and relate to credit performance, ultimately.
We've discussed a little bit about large language models, but keeping on this point about explainability, don't large language models pose some unique challenges to explainability? And does that kind of create an inherent limitation on our ability to use them?
Definitely. That's complete example of things not making sense necessarily, right? From an explainable point of view. However, I think, as we move on into this space even deeper, maybe there's going to be ways to find, again, fine tune attributes and variables and try to make them explainable, even though at first sight they're not.
Yeah.
You're not going to penalize a consumer for having a transaction, say on the credit card, that they went and they bought, an engagement ring, right? Versus they went and then they bought, groceries.
Yeah.
So that's the challenge there of why are you more risky? Because you went to the jewelry store versus you went to the grocery store and you did your groceries for the same, maybe amount of money, But
that's not a very expensive ring, then, Andrada.
No, well,
or really expensive groceries.
I was
going to
say, chances are, I know my wife would say no. Okay,
no, I would think so. It just came on top of my head, so it didn't come out right. But you know what I mean. You cannot like characterize a specific, human behavior just based on a description of the transaction, for example, or description of whatever is in the data that you're looking at as text.
And even though, like even from an LLM's perspective, even though like it can interpret that data, it can understand that data, which is sort of the novel insight or thing that's moved forward, right? These older models that we were using, they couldn't parse this unstructured data. Just because LLMs can parse this data doesn't mean all of the data that they can parse can be used, or that their interpretation of it is necessarily going to work with these standards that we're talking about.
Exactly right.
Yeah,
exactly
right. And again, to me, I have no issue using this stuff in commercial credit, in bond risk assessment, even in fraud transactions, or fraud decisioning, but credit decisioning, I think, has to be held to a higher standard. And think about where we are in the world of regulatory acceptance of machine learning as it is. Most banks are not using it still. So I would, fintechs broadly using it probably for the last 6, 7, 8 years, but banks are still very hesitant. And so what I would say is, you don't go from A to Z when it comes from AI and ML. It's going to be a series of steps. And I think banks are going to take a while before LLM creeps into credit, right? Even if what Andrada referred to earlier, maybe we advance explainable LLMs, to a point where people are satisfied that this meets the test. But I think banks will be slow followers. That's what I think, right? Maybe there'll be some people in the fintech space because they can squeeze out a little bit more incremental AUC that way. But generally speaking, I think banks are going to be slower to adopt these for credit. That's what I think.
Agree.
Yeah, no, I think that is totally fair. And I think not jumping all the way from A to Z is probably a good place to leave it in terms of advice for folks who are looking at this space. All of this is incremental in terms of finding small wins and small places to add value. We could keep going and going, but we've already taken up too much of your time. Kevin, Andrada, on behalf of me and Kareem, thank you so much for joining us for this discussion. I learned a lot and had a lot of fun, so appreciate it.
Thank you.
Thank you. Thank you for having us.